Most of us are familiar with the classic tortoise and hare fable. The hare, confident in his speed, races off but then decides to stop and take a nap. Meanwhile, the tortoise maintains a slow and steady pace, eventually crossing the finish line first, not because of his speed, but because of his consistency. He stayed the course and didn't let any distractions take him off track. This simple story offers valuable lessons for investors, particularly in election cycles, which create heightened uncertainty and heightened temptations to get off your investment plan. While no one, including us, knows what's going to happen this election season or what impact that will have on the economy and the markets, we can look back at history and find 6 lessons that we can learn. The first lesson is that stocks usually go up. Research shows that people tend to let their political opinions leak into their investment portfolios. Republicans get more conservative if Democrats are in charge, and Democrats will get more conservative if Republicans are in charge. But history says both of those would be mistakes. If you had invested $10,000 in 1960 and simply bought and held that portfolio in an S&P 500 index, that $10,000 would have grown to $1.89 million. If, on the other hand, you had gone to cash during every election year, your portfolio would have only grown to $1.14 million. And despite all the doom and gloom from political candidates, all that negativity has not translated to the stock market. From 1928 to 2019, stocks returned 12% per year in non-election years, compared with 11.6% in election years. So election years may be slightly worse for the stock market, but even that might be a stretch. If we simply take out the year 2008, the average election year has actually been 13.9%, even higher than non-election years. So election years, in general, are not bad for stocks, but the most surprising lesson of all may be number 2, and that is that the party in charge has not historically mattered all that much to stock market returns. Going back to 1853, stock market returns have been virtually even under both parties. And if we look at economic growth, we see that it's been 1.8% per year faster under Democrats. However, further research suggests that the majority of this is due to things outside of the politicians' control. In fact, one research paper found that there is no impact of either fiscal or monetary policy to the long-term returns of the stock market. And this chart shows the historical performance of the stock market under different partisan controls from 1933 to 2023, excluding the dot-com bust of 2001 and 2002. The key takeaway is that stocks have historically performed quite well under almost all political situations. The worst performance was under a Democrat Congress and a Republican president at just 4.9% per year, with a Democrat sweep averaging 9% per year, compared with a Republican sweep averaging 12.9%. The other scenarios where you had gridlock were actually quite good for market returns, with average returns of 13, 13.7, and 15.7. And while it may surprise you that political parties have very little impact on stock market returns, when you think about it, that makes a lot of sense. There are a lot of factors outside political control, including natural disasters, pandemics, foreign trade policies of countries like China and Japan, geopolitical tensions, which officials were elected, short-term interest rates, long-term interest rates, the economic environment you inherited, like the unemployment rate, etc., what kind of technological innovation occurred while you were in office, what monetary policy was while you were in office, the timing of when you took office. So if you took office right before a huge recession that you had very little to do with, or you were in office right at the bottom of a recession like 2009 and you benefited from the market run-up. Neither one of these has much to do with the president and a lot more to do with timing. Politicians have no control over investor sentiment, the inflation rate they inherited, or the actions of millions of investors, which ultimately make up the stock market. Lesson number 3 is that so-called expert predictions are often wrong. For example, in March 2010, The Affordable Care Act was passed by the Obama administration. Many pundits expected that healthcare stocks, health insurance stocks in particular, would suffer from this new law, which required that they cover pre-existing conditions and other things that would ultimately be bad for those companies. However, over the 2.5 years following the Obamacare law being passed, health insurance stocks like United Healthcare and others generated a total return of 95%, compared with the broader stock market returning just 52%. So expectations of doom and gloom turned out to be completely false. And in the lead up to the 2016 election, many pundits expected that a Trump presidency would be terrible for the economy and stock market, but as it turns out, that was not the case. And lesson number 4 is that the 333,332 is more important than the 1. This is the current US population, and this is the number of presidents that we have. This chart shows the number of federal offices, the number of total public government employees, and the total number of private sector employees. There are 542 federal offices, which is shown by this chart. You can't even see the line. There are roughly 20 million public employees, and there are over 135 million private employees. And over any 4-year period, the collective decisions, innovations, and productivity of these 135 million people are far and away more important to the economy and the stock market than these 542 federal offices or the public employees that often follow their mandates. Lesson number 5, markets tend to price in elections before they actually happen. The performance of the S&P 500 index has correctly predicted 87% of elections since 1928 and 100% of elections since 1984. Markets are rarely surprised by who wins an election. They tend to price that in before the election actually occurs. And even when the markets are surprised, like in 2016, they tend to adjust fairly quickly. And finally, lesson number 6, markets dislike uncertainty. In years where an incumbent president is re-elected, stocks produced an annual return of 13.4%, compared with just 9.3% when a new president was elected. In this election cycle, we almost have 2 incumbents. Obviously, the market knows what to expect from a Trump administration, and a Harris administration would likely be quite similar to the administration she was just part of. In either case, once the uncertainty of an election is resolved, the market tends to respond favorably. So the most important thing about this election cycle is most likely going to be when it's finally over. Just remember that the media profits off of eyeballs, and fear and negativity tend to attract attention. So as much as possible, try to maintain calm. Just remember that high-quality businesses like the ones that we invest in can thrive in virtually any political environment. Stocks have historically gone up in most years. In fact, in all but 2 of the US presidents since 1960, the stock market has had positive returns, including the 2 administrations currently on the ticket. Most importantly, go out and vote with your ballot, but just don't vote with your portfolio. If you have any questions about how the election cycle may impact your portfolio, reach out to your advisor. We'd love to talk to you more about how this particular election cycle may change your portfolio. As you might be able to tell from this video, we're not likely to make big sweeping changes. If anything, we might change a stock or 2 at the margin, but only if it seems obvious that those changes are likely to have longer term effects. We tend to hold on to stocks for an average of 3 to 5 years, so we're unlikely to make changes based on short-term expectations. As always, we appreciate the opportunity to serve you and your family. Thanks for watching, and we'll see you in the next video.